Spartans! Ready your breakfast and eat hearty. For tonight, we dine in hell!
Did we just take a big lurch towards the final liquidity crunch of this current monetary system? A big maybe. This is Rafi, the Endgame Investor. What I want to talk about today is what happened yesterday in response to the Fed minutes release. We'll go through the controversial and disturbing portions of the minutes to dissect what exactly made the markets have indigestion and why I believe that the 2.5% mark on the 10-year yield will be the trigger that finally pops this 50-year-old bond bubble. First, a little bit of history. Going back to 2008, the quick deflationary crash happened because debt was being liquidated, and debt is counted as part of the money supply. Banks can count assets against debts held, but once those debts go to zero because they're not going to be paid back, then the money supply shrinks and asset prices fall, leading to a deflationary collapse. This is what happened in 2008, and it took a few months for the Fed to reverse course and print enough money and monetize the debt that was being defaulted on to reinflate the money supply and keep the bubble going. In 2020, the deflationary crash was even quicker, but the Fed had its fingers on the monetary triggers much faster, and that's why the deflationary crash only lasted a few weeks. This time, it is going to last maybe a few days, maybe a week, maybe something around there, but it won't last much longer than that because the Fed is all ready to go to print trillions more dollars to keep the current bubble going. But this time, when they decide to do that, they will destroy the dollar, and this will be the last one. During this time of about a week or two, as happened in March 2020, gold and silver are likely to fall. This is why I advise my subscribers to always have cash to maintain emotional balance, because I was always aware of the fact that this was very possible and to be ready to buy it, just like I did in March 2020.
Spartans! Lay down your weapons!
Persians! Come and get them!
Because once the Fed reverses one last time, it is very likely that global markets are going to understand that the dollar is toast once and for all. And the only real competitor to the dollar is not another fiat currency, but it is gold and silver themselves, the monetary metals on which the value of the dollar has always been based. So first, let's go into what's happening in the bond market. Something big happened in the bond market yesterday. We moved to 1.74% on the 10-year rate. What does that mean? That we now have a double top in place, looks like a triple top at about 1.74. If that is broken, then from a technical perspective, rates are going to head higher. The 200-week moving average is right now at 1.8%. Break through that and you will have even more technical traders selling bonds. Notice here the red line I drew in since 1994. This trend line from 1994 has been intact for about 27 years. It was touched here in 2000, right when the market was peaking. It was touched here in 2006 when the housing bubble was peaking. It was touched here in 2007 when the market topped in 2007. It was touched here in 2018, just before the crash of December 2018. And judging by the pattern of highs in bond yields and tops in the stock market, we could have a situation here where rates skyrocket up and above 2.5% very quickly, because as everybody knows, real rates are negative and there is no value in a bond, in a treasury bond, other than what the Fed is willing to pay for it. And if they're going to taper and stop their bond purchases, then no one is going to be buying on the other side, and you're going to start seeing selling. Here is what the Fed minutes said that is causing this to occur. These are paragraphs that I highlighted, sentences really. Sentence 1, some in the FOMC observed that as a result, depending on the size of any caps put on the pace of runoff, meaning the taper, the balance sheet could potentially shrink faster than last time. I believe CNBC is the one that said that the time for the finishing of the taper, for the point when the Fed would no longer be buying any bonds at all, would be March. It is now January and the taper has not even started because the rate of increase in the balance sheet has actually increased since the taper was first announced on November 3rd. So if they're going to stop all bond purchases by March, that is going to be cold turkey now, or in a month, or in a few weeks, sometime soon, in cold turkey, when the Fed suddenly stops buying bonds. Who's going to buy them? That is why interest rates are rising fast now, and they could rise even faster over the next few weeks. 2, some participants judge that a significant amount of balance sheet shrinkage could be appropriate over the normalization process. That means as they are hiking rates, they will at the same time shrink their balance sheet. That is what they want to do, or that is what they're signaling they want to do. And last time, that is not what happened. The two processes were separate. They did not do both at the same time. This time, they're saying that balance sheet runoff, shrinking the balance sheet, and raising interest rates will happen at the same time. That is going to put huge amounts of pressure on the Treasury market, whose only buyer is the Federal Reserve itself. Paragraph 3. Almost all participants agreed that it would likely be appropriate to initiate balance sheet runoff at some point after the first increase in the target range for the federal funds rate. They want to start balance sheet shrinkage after the first rate hike. However, participants judged the appropriate timing of balance sheet runoff would likely be closer to that of the policy rate liftoff than in the committee's previous experience. They're going to start both processes faster than last time, basically. And finally, what do they expect PCE inflation, their favorite inflation gauge, to be in the next 3 years? PCE price inflation was therefore expected to step down to 2.1% in 2022 and to remain there in 2023 and 2024. Does anyone actually believe this? That PCE price inflation is going to stay at 2.1% for 3 years from now on? That's not happening. They know it, everyone knows it, and people are selling bonds because of that. Let's illustrate, let me show you how much the bond market is reliant on the Federal Reserve these days. This is a spreadsheet compiled by SIFMA, which tracks all the statistics in the Treasury market. And here you see the holders of treasuries outstanding, the year-over-year change. Here you have the Monetary Authority, which is the Fed, from this box here at $2.33 trillion in Q1 2019, now to $5.833 trillion in Q3 2021. That was 2 quarters ago. It's even more now. They have more than doubled their treasury holdings, while pretty much everyone else, if you look at the year-over-year statistics here, individuals down consistently quarter after quarter. Mutual funds are down 13% this quarter. They've stopped buying. Banking institutions are up, but much less than the Fed. Insurance companies are pretty stable. They are not buying anymore on net. Monetary Authority up 61%, up 111%, up 117%, up 110%. Every quarter they're doubling. They're still buying, 13.2% up. State and local governments picking up a little bit, nowhere near as much as the Fed. Foreign international buyers are non-existent. You see here only 2.2% rise from last quarter, and only in the single digits since 2020 started. They are not supporting this money printing as they were in 2008. Pension funds have also stopped buying, and others are down 22%. And so we see here that the Fed threatening to pull out of the bond market entirely by March is scaring a lot of traders. And if we break those technical marks and we push above 1.8, we can very quickly find ourselves in the mid 2% range, which would really cause a panic in the Treasury market. And yes, the Fed is going to step right back in because, as we all know, it is data dependent. During this time, as Treasury rates are rising, trying to catch up with the inflation rate, we could see gold and silver sell off hard over the very short term. But we need to have the cash ready and able to capitalize on that, because this is where the real money is made. And the next time the Fed pivots back to money printing, I believe it will be the last time before the final end game arrives.
Spartans, prepare for
This is Rafi of the Endgame Investor. You can support me by signing up for a 2-week free trial of the Endgame Investor to understand how I'm trading and analyzing this madness. It is going to get rough until the Fed turns around. And once the Fed turns around one last time, it is going to get quite glorious. And the end of the monetary system is at hand.